Now we're going to move into the other side of extrinsic value, and that is the volatility risk. We just wrapped up talking about intrinsic value, and then the first portion of extrinsic value, which was the time risk. Now let's talk about volatility. Volatility is one of those things where you see it presented, and there's many ways you can present it. If you've taken my courses, any other ones, I'm a full believer of the KISS method. Keep it simple, stupid. So that's how I'm going to approach this. And will I probably offend somebody that's got a PhD in mathematics or calculus or all that sort of stuff? Yeah, probably. But we're traders. We're not mathematicians. We're not rocket scientists. We just need to know the overall kind of feeling of things and an overall understanding so that we can move forward as traders. So as far as volatility and volatility risk is concerned, let's just start at step one. What is normal? That's actually the key question. Like I said, you're going to see all sorts of fanciness out there, mathematical equations, formulas, but bottom line, all we care about is what is normal and what is non-normal, and that's what volatility is. So looking down here at this basic line, you can see that the blue line here represents normal. And anytime that the line is not on normal, it is therefore non-normal, right? If it's not normal, then it's got to be non-normal. And that's what the neon green represents, just non-normal. Now, question to you, what is it right there? When there's that intersection, what's going on? Hopefully you're saying, well, it's an intersection, so therefore it's at the normal line, therefore it's normal. Exactly. So, that point there is normal. Things are not normal, not normal, not normal, all of a sudden normal. In other words, things are volatile, 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 not volatile. Volatile, 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 not volatile. Volatile, you get the point, not volatile. Now, in terms of, how non-normal, to what extent does non-normal get, that's where we have magnitude. So magnitude is simply, when you see that out there, that's just the way of saying, yeah, wow, that just got, non-normal to that extent. That's all that magnitude means, is just how much, to what extent is whatever you're measuring. Keep in mind, I'm not talking about stocks. I'm not talking about options at all right now. I'm talking about anything in life. A person, a person that's, kind of has mood swings and stuff, they're going to be volatile. To what extent does their mood swings go? Well, that's going to differ. Sometimes they'll just get a little bit angry, and other times they're going to be chucking chairs across the room, throwing, flipping desks all over the place. So, the personality, the mood of somebody. So if this was a psychology course, and we're not talking about stocks or options, I would just say, this is somebody's, mood when they're perfectly fine, perfectly happy, and then they start getting all depressed. And then another portion of the day, now they're throwing chairs across the room. And then here, they're kind of feeling sorry for themselves. And then here, they get a little bit angry, a little bit annoyed, but not too much. Here, they're just sobbing. I mean, look at that magnitude of the volatility. They are sobbing tears. And then here, they are throwing things out of windows. They are hitting things with baseball bats. Then they chill out. Now they sort of feel bad about hitting things with baseball bats. No, never mind, I'm angry again. So you get the point. Volatility is not just with the world of trading. It's really, in personal life. So if you're a psychologist, you would want to know about volatility, right? You would want to know about volatility risk, because if you're analyzing somebody and trying to work with somebody, you need to understand how the volatility works in regards to that person. Well, now let's get back on topic and back on course and start to, apply this more towards actual stocks. So at the end of the day, the kind of short way around it is non-normal equals volatility. If something is not volatile, then it's perfectly normal. Now, within the world of options trading, so no more talking about people and their mood swings, let's talk about options trading. There's two types of volatility. There is historical volatility, and then another one which we'll talk about. So what is historical volatility? That's just simply, it's looking into the past. So that's a key word. We're looking into the past of a stock's price movement. And what that's allowing us to do is just see, well, how has it moved before? What has been normal? What has been not normal? So going through our little line again, just to kind of, build on top of what we've said, we can all agree, hopefully, that, things didn't get too crazy there. So that would be considered, in our lingo, low volatility. Right here, you can see the big magnitude of the mood. To what extent? Well, this was a big extent. Therefore, that would be high volatility. And again, the key word here is historical volatility is looking into the past. So by looking into the past, looking into what has happened, that's going to give us an idea of some things. So, how has it moved before? But everything is in the past. That's, the key word obviously being historical. Hopefully you had a history class, or if you did, paid attention. But history is learning about things in what? The past. Like I said, I'm not trying to insult your intelligence, but I want to keep things basic, and I want to just start from the beginning and move forward. So let's have a little quiz here. I have a question. Looking down here at our graphic, so looking into the past history, so let's look at the historical volatility. Which stock is more volatile? Hopefully you're saying, well, that's kind of a no-brainer. I would say stock ABC is more volatile. Why would you say that? Well, you're starting to look at the magnitudes. Again, you're looking at the how muches. Well, here was a how much. And then you look here at stock XY, stock XYZ. And yeah, it was volatile. There's no doubt about it. But you can see it never really, to what extent. And that one, that's probably the most extent right there. Maybe it would be tied with this one. But you get the point. Yes, it's volatile. But in terms of, the magnitude, to what extent is it volatile? Stock ABC wins in a landslide. So let's, quick little math speak, but I promise it'll be very short-lived and hopefully painless. But in math speak, historical volatility is the annualized standard deviation of price stock movements. So let's quickly go down here and press the translate button. So translation, all that means is it's the measurement of how much has the non-normal fluctuated over the past year. So how much has volatility fluctuated? That's all that, the standard deviation stuff means, is we want to know to what extent, how much has the non-normal fluctuated over the past year. It can be different, periods, but for this, just the past year, that's the traditional definition of historical volatility in regards to options. Now, through my years of teaching, I know that some people are visual, other people just want to maybe see some numbers. So if you're still a little, I'm not quite sure, let's just look at things from a numbers perspective. So no more numbers or squiggly lines. So just simply another way to view this is, what happens if I told you, so wipe that image out of your mind, but if I said, you know what, the stock range of XYZ for 1 year was $65 to $68. And then I said the range of stock ABC for 1 year was $8 to $68. And if I were to say, so, which one do you think is more volatile? I hope you're saying, wow, that's a pretty crazy stock. In 1 year, it went from $8 to $68 and traded between this range. Whereas you look up here and you're probably thinking, wow, maybe you yawned or something. Wow, $3 was the range for the stock over 1 year. Yeah, in a landslide, not even close. Stock ABC, just looking at the numbers, this is by far more volatile. So like I said, the fluctuation of non-normal was clearly quite a bit more in regards to stock ABC. So you would just say, yeah, stock ABC was much more volatile than stock XYZ. And how are we doing this again? What are we doing? We're looking backwards. We're looking into the past. We're looking into the past of the numbers to say, wow, yeah, the fluctuations, to what extent stock ABC wins in a landslide. Now, if you're like myself and use technical charts, this is a very easy concept, or hopefully is not a foreign concept, because with charts and as a technical chart trader and technical trader, all we're doing is looking into the history to attempt to forecast, price movements, trends, patterns. But now as options traders and, as this pertains to volatility risk, we're looking into the past to try to forecast into the future what types of things we can expect from volatility. So if you don't use technical charts, maybe you have a little bit more difficult time in terms of, looking into the past to try to forecast the future. But if you do use charts, then this is something that you're very familiar with, of this historical concept and how past can be a very good indicator for the future. All right, I feel like we should have a drum roll or some kind of dun dun dun, but the big word that maybe you've seen and has scared you or has, just kind of made you rattle in your boots, implied volatility. What is implied volatility? And again, this is one of these things where, I've seen some people try to explain it and you see it's just, wow, it really doesn't need to be that complicated. So let's break down implied volatility and let's just look at things with the KISS method. Let's just keep it simple for people like myself who are stupid. So implied volatility. The market is asking this question. This is what implied volatility revolves around. The market is asking this question. Based off of what has happened in the past, what does this imply will happen in the future in regards to volatility? So those 4 words pretty much summarize what implied volatility is doing. It's looking into the past, aka historical volatility, to try to figure out what will imply, hence the word implied volatility. And by doing that, we want to see what may happen in the future as far as volatility is concerned. So going back down to our graphic, the only thing that has changed is instead of this arrow pointing backwards, now where is it pointing? Into the future. So it's looking into the future, attempting to forecast what non-normal will be. Because remember, non-normal is what volatility is. But the one big thing here is there are no guarantees. The market can be right or wrong. Hopefully as you've traded, you understand the concept that there's no such thing as a guarantee in the market. As nice as that would be, that's just not how it is. So this is all just forecasting. It's nowhere does it's it's trying to figure it out. It's trying to figure out what's past volatility will imply for the future, but there are no guarantees. So it's just a way to try to measure, to try to gauge. It's kind of like a flashlight in the dark. Just because you're using a flashlight in the dark doesn't mean you're not going to run into a tree or step on something and trip over something. It's just a tool. It's trying to help you out, but a flashlight in pitch black is still not a guarantee of total safety. Now, this is a concept that scares a lot of people, and I understand why. It's a statistical thing. Maybe if you've taken statistical classes in college, then okay, you understand it's nothing to be intimidated by. However, if you haven't and you start to see this stuff, this is where wow, this stuff looks like Chinese. What is being talked about here? Well, I'm going to break it down, and I'm going to try to just kind of make it as relatable and as friendly as possible. So maybe this whole time you've been thinking, well, you keep talking about non-normal. What is non-normal? To what extent? Well, how does quote unquote normal pertain to the options market? And this is what breaks it down. This is what, this is a huge backbone within, advanced option strategies. And it's really nothing complicated. The way some people present it and just look at it from, strictly, a mathematical, statistical perspective. Yeah, I can see how it's intimidating, but, bear with me. I promise. It's just something that is going to not be nearly as painful as what you may be expecting. So again, think back to our image. Remember, we had that blue line, and that was normal. Well, within the world of options, within the world of trading, we still have that same principle. We have normal. Now, the good thing about historical volatility, seeing how things have acted in the past, is it allows us to start to deal with this word, and this is something that is, again, one of the backbone principles of options trading is probabilities. We can start to try to leverage, try to gauge, try to figure out what sort of probabilities are in our favor or not in our favor. And that's what things are. Your probabilities of getting hit by a car walking across a freeway without looking both ways is pretty high, right? But what's a way you can dramatically decrease the probabilities you get hit while you're crossing a highway? Well, easy one would be just look both ways. Do I see any cars coming? Oh, no, there's not. Okay, so a simple movement like that. That's what's going on with options, and that's what this is explaining is probabilities. If we know probabilities of something are good or bad, well, then that's going to really start to influence our decision making, and it's also going to influence, the pricing within the market. Remember, this, is part 2 of the whole options premium. How exactly is an option premium priced? Well, this graphic here has a lot to do with it. So what is normal? Well, the way this is called, ironically enough, I keep talking about what is normal, what is not normal. Within statistics, this is called normal distribution. Now, you don't have to worry about that, but it is literally called normal distribution because that's exactly what it's telling us is what is normal, what is not normal. And this can be applied to anything. This could be applied to people's personalities again. I mean, it has many different applications. It could be applied to, you give somebody the choice of red, green, or blue. It's going to tell you, well, what do people normally choose? What is the not normal color choice there? So that's all this is. So the way to look at the distribution is after you look back at historical volatility, historical numbers, it's going to give you ranges. So the expected range from perfectly normal. So like I said, here, this is perfectly normal. The majority of the time, it's going to be within this area here. It's going to be in the expected area. Why is that expected? Well, if you add these up, that gives you 68%. And again, not trying to insult anybody's intelligence, but 68% is well over half. Half is 50%. So if something is over half, then hopefully you're saying, well, that would be expected. If that happens more than half, keep in mind, it almost happens 3/4 of the time, which would be 75%. Not quite, but it happens well above half of the time. So therefore, it's expected. It would not be impressive. It would not be shocking if it's expected to happen. You know, if there's dark rain clouds above you, or dark rain clouds, and you get hit by a drop of rain, are you going to be impressed? Are you going to be shocked? No, you're going to say, well, that's pretty expected. Those dark rain clouds up there, it looked like the probabilities are it was going to rain. And the way the distribution works is 68% of the time, or in other words, one standard deviation. I don't want to offend the people that are into statistics, so I figure I better use one word there. So one standard deviation from perfectly normal, deviating. Think about the word one standard deviation. So deviating from the norm by one standard is going to happen 68% of the time. Now, in what direction? That's where it's a little bit different, because it could go in this direction 34% of the time, or it could go in that direction 34% of the time. But the point here is that within this area, that's where it could be the stock price, it could be somebody's personality, it could be whether or not it rains, is going to be 68% of the time. Now let's move out a little bit more. Now we're looking at two standard deviations. So deviating that much more, and notice what happens. So this is perfectly normal. In order for this perfectly normal to get out to these areas, there's only a 14% chance that could happen. Now, of course, it could go out to these areas too, so that's another 14%. So in total, there's a 28% chance that the range could come out to these areas here. And as Ron Burgundy would say, for anybody that's an Anchorman fan, you know, that's impressive. You got to give credit where credit's due, because that's slightly over a quarter, right? A quarter of something happening is 25%. So only a quarter of a time, you know, does this have a chance of happening? Probability speaking, you know, the odds, the probabilities of it happening are only 28%. So yeah, that's pretty impressive. But there's one more, we can take another step further, and that's coming out 3 standard deviations, and that puts us in what I like to call the shocking zone, which is, you know, for it to go from perfectly normal all the way out here, 2% odds, 2% probabilities of that happening, which is going to produce that, right? I mean, that's shocking. It's, whoa, are you serious? Or, of course, to go all the way in that direction, again, 2% chance, but you add 2% and 2%, that's going to give you 4%. And if you add these up, that is 100%. But point being, the shocking area, for something to deviate from the normal, what is not normal, for that to happen, for that to be not normal, 4% chance, but in one specific direction, you know, a 2% chance. So it's one of those things where hopefully you're saying, okay, yeah, so that's, you know, basically like winning the lottery in this type of situation. The odds, the probabilities are not very good. If I told you that your probabilities of, you know, getting hit by a car were 2%, you'd feel pretty good. Now, you would still say, well, if I look both ways, I can probably drive this down to about 0%, and that is very true. But if I said the odds, the normal would be getting hit at 2% here, you'd feel a lot better in terms of, I said, well, you're expected to get hit because it's expected that you're within this range, which is 68%. You're not going to feel so good about things. But that's all normal distribution is. That's how we're defining what is normal. By looking back into the past, this is how it projects into the future, what we think, what the market thinks is going to be normal or not normal. What the market thinks is going to be expected. So what the market expects, what would be impressive for the market, and then what would just be totally shocking for the market to happen. So, you know, the market is very smart. The market is very efficient. It has these 3 levels. It has an expected zone. It has the market where it kind of, you know, claps its hands. Impressive. And then it has where you can make the market's face turn into that, where it's like, wow, that's pretty shocking. So believe it or not, the market does have a personality, and the market does have stages that it's projecting for you based off the mathematical figures from the past. Again, historical volatility, but this is what implied volatility all revolves around. So now let's bring it from more of the kind of overall theoretical areas of, you know, what is implied volatility? What is this, you know, normal distribution? What's normal? What's non-normal? What's impressive? What's shocking? What's expected? Now let's start to apply some numbers to it. So implied volatility is given as a percentage of the stock price itself. So for example, let's talk about stock ABC, and let's say that it's trading for $60. Let's also suppose that the IV of stock ABC is 15%. Now, the good news is here, you're not gonna have to pull out your calculator. You don't have to, okay, I gotta do statistics now. I gotta learn some calculus. None of that. Don't worry about it. It's sitting there for you. So no worries on that. The first big piece of good news is, like I said, it doesn't need to be complicated because these numbers are given to you. So the IV of stock ABC is 15%. So the question here is, what is implied, looking into the future, what is going to be the implied range of this stock based off what has happened in the past, which is what hopefully you're saying, stop repeating it, Clay, historical volatility. Good job. So looking at the historical volatility, what can we think about what that implies for the future? Well, the quick math there is $60 times 15% is going to be a $9 move. Now, again, I don't want to insult your intelligence, but a stock can move in what? Two directions, right? It can go up or down, or of course stay the same, but that's not really a move. That's just staying the same. So implied volatility is implying a $9 move. So remember, this is very important. IV is just the market's way of trying to forecast future volatility. It's not an exact science. This is all theory. It is not guarantees of anything. It is by no means saying that stock ABC is for sure 100% positive going to move within that $9 range. Now it thinks it will. The market is forecasting it will, but that's not a guarantee. It's just the market doing its best to try to project into that future. So let's go back to our graphic here and now assign some numbers to things. So remember, IV cares about the one standard deviation. Remember, they care about what is expected. That is what IV is all about. That's their bread and butter. They are, what is expected to happen. So looking at this, perfectly normal would be $60 from our example. The stock is at $60. So at that moment in time, at that snapshot in time, the stock is $60. Therefore, that is perfectly normal at that point in time for the stock. Now let's apply, well, what would be expected? What is IV saying? Well, we're going to go out that one standard deviation. So 34%, if the stock falls, is going to be $51. So 34% of the time, it's expecting the price to be, at least at $51. On the flip side of things, 34% of the time, it being the market is expecting that the price will be at $69 because that is a $9 move in the direction. Remember, the IV going into this was 15%. We calculated that $9 number. So $9, that is not normal, but it's expected. So by no means is it shocking. By no means is it impressive because the market expects it. $51 to the downside, $69 to the upside. Now so another way to put this would just be, that, according to historical volatility, and then what implied volatility is saying is that the stock is expected to trade between $51 to $69, 68% of the time. That may sound, but just remember what we're doing. 34% of the time, it's expected that it'll be down at 51. And then 34% of the time, it's expected that it'll be up around 69. 34 plus 34 is 68. So 68% of the time, the stock is expected to trade between $51 to $69. If there's dark rain clouds sitting above you, you are expecting it to rain. You are thinking, you know what? There's probably at least a 68% chance that it's going to rain, given I'm looking up there and there's those big storm clouds up there. So that's what that means. Or in other words, you could say that the market expects the range or expects the price to be outside of that range 32% of the time. Now, where does 32 come from? Well, that's taking when the market's going to be impressed and when it's going to be shocked, adding those two together, and you're going to get 32% of the time. So the market is not unrealistic. The market is not arrogant. The market doesn't say, we expect it to be in this range 100% of the time. No, the market's not stupid. The market gladly accepts the fact that, there's going to be those times where things get crazy, and 32% of the time, things are going to either be impressive or shocking. So I'm going to repeat this throughout the course. The market is very efficient. The market is hard to catch off guard, and it factors all this in. And the reason for that is the stock market is very cruel to people that are not disciplined, but it's also it's very straightforward in terms of the way these numbers work. So not guarantees, but it can be a very efficient way to go about things. So just to reiterate, now that we have that $9 number, all the market is saying is, you know what, 68% of the time, based off historical volatility, which we're projecting into the future as implied volatility, this stock should be between 51 to 69 majority of the time, which is 68%. However, we know that things can get crazy. We know that things can get impressive and shocking. Therefore, we're expecting about 32% of the time the stock's going to be outside of that normal range. Again, normal being that expected area. Now, just to clear, not clear something up, but just to make note of, implied volatility is not always talking about 1 year. For us traders, we care about IV for the lifespan of an option, and as you know, lifespan of an option can be 1 week until it expires. It could be 1 month. It could be in between. It could be longer. But that's what implied volatility for us as traders. We're not always looking at 1 year. The implied volatility is going to depend on, well, what's the lifespan of the option? Remember, options expire. So at that point in time, all right, whatever. So we care about things in regards to the lifespan of the option, and that's always going to vary. There's going to be different implied volatilities for different situations based off of that time value. So we care about what is the lifespan of the option, and that's the implied volatility that will be, taken into account throughout throughout any of the trading strategies. And technology is a beautiful thing. I kind of already noted on this earlier, but you're not going to have to sit around and type these numbers into a calculator or spreadsheet or anything like that. The trade plan is not going to consist of you sitting there spending the majority of it trying to figure out statistical analysis or anything like that. In fact, you don't even need to look at implied volatility. And I say that because you can use a measurement called probability of in the money, and at least Thinkorswim classifies that as prob ITM. I'm not being paid by Thinkorswim. I'm not, it doesn't benefit me at all. Hopefully, if people are watching this 5 years from now, they still exist, but they've been around for a while. But it's a very useful options platform. I use them. I don't use them to execute because I don't want to. I have better commissions. But as far as the data and the numbers they can give you, I will recommend, and I will continue to recommend throughout the course. Thinkorswim is probably worth opening up, if anything, just for the data that it allows you to access. But I'm not saying that you can't access any of this data from other places. I'm just saying that the Thinkorswim platform, came highly recommended to me. And after digging through it and so forth, there is a lot of stuff there, and this probability of in the money is one of those statistics. So let's take a look at this for some real life examples here, and you're going to see what I mean about how this probability of in the money really kind of just cuts through everything and makes it very clear. So this is just an automatic calculation. It's done now. It of course uses implied volatility within the calculation and all that stuff, but again, we're not here to be mathematical. Rocket science engineers or anything like that. We're here to be traders. So I'm not going to get into all the mathematics of it, but just, this statistic is calculated for you. Technology is a beautiful thing. Awesome. Let's move on. So a real life example, and I took this from the Thinkorswim platform, but at the time when I created this slide here, Apple was currently trading for 124.25. So for our example here, at this snapshot in time, 124.25 was perfectly normal. That was a perfectly normal thing. Now the lifespan, remember we just talked about that, the lifespan of the option was 6 days. So at that point in time, this is what the calls and puts look like. So expiring in 6 days, the probability of these calls being in the money, 44%. Now, why would that be 44%? And this is for a strike price of 125. Hope you're saying, duh, bozo. They're not in the money right now because it's trading at 124.25. The price right now, or this price for these strikes is 125. So conversely, this should not be shocking. The probability of in the money for the puts is 56%. Because, why? Well, of course, the basic stuff here, the strike price is 125. If you had those, well then yeah, you would be in the green. However, why are those are pretty close, right? 43%, that's basically a coin toss right here. 56%, that's basically a coin toss. Well, it's very close, right? Nothing crazy would be going on. It would not be crazy to see the price go in that direction. That would be perfectly, expected. It would not be crazy to see the price go in that direction. that would be perfectly, expected, because again, prices at 124, perfectly normal, is right here. Just going out a little bit from 125, where the price needs to get, nothing shocking, right? That, nobody, I don't think anybody would be shocked to see these after 6 days, see the calls finish in the money, or see the puts finish in the money, or vice versa. Nobody would be shocked here. Nobody would be impressed, because it's pretty darn close. Therefore, it's pretty expected to go in either way, and that's why those probabilities are basically at 50%. 50% is going to be that coin toss where it could go either way, and that's why, based off of the strike price and the current price and the time left, yeah, that could go either way. That would be expected. It would be within this portion. But let's go out some more. Let's look at the 132 strike price. Now you see for the calls would have basically a 4% chance to finish in the money based off, only having 6 days, which shouldn't be shocking, right? Apple would need to go from 124 and then make a big old move in order to put these strike price calls in the money, right? So by using all the calculations, that's what I mean. This probability of in the money, this thing right here is a beautiful calculations. It's basically telling you that at this exact point in time, the odds, the probabilities of Apple, making that move from 124.25 all the way up to, making these in the money. You're sitting way out here. You would basically you'd have to not only be impressive, Apple would not have to, impress the market, but would also have to, shock the market. It would have to just be, wow, that is extremely impressive. On the flip side, the puts, 92% chance that those are going to finish in the money. Again, with only 6 days left, Apple would have to make a big move in order to make these puts outside of the money. So in this case, it's looking at, okay, it's not going to be shocking at all. You're going to be way in this direction. It would be very hard to shock the market in terms of making these out of the money. So probabilities here, 92% in the money. Notice, we're not talking about implied volatility anymore. Now, implied volatility definitely plays a role in this. That's why we needed to talk about, and we'll continue to talk about, implied volatility. But the probability of in the money can be a very useful statistic, and one that we'll talk about more throughout the course. But that's all. It all hopefully makes sense in terms of you think, what, Clay, I don't even necessarily know. You're kind of stating the obvious. I am stating the obvious. With 6 days left, it would need to be quite impressive for Apple to go up from 124 up to 132. But even with that, well, how do you know that? If you're saying, well, for Apple, that's a pretty big move. Well, how do you know that would be a pretty big move? Because you as a person, if you look at Apple quite a bit and trade Apple quite a bit, you're subconsciously, your mind is starting to recognize and get a feel, quote unquote, feel for how volatile is Apple. Well, the market's doing that for you also, but it's doing it with straight up numbers and statistics, and that's where implied volatility comes in. If you're looking at a stock and you're used to, trading a stock that has huge price swings, where a $20 price swing is not a problem, then to you, you're thinking, well, actually 6 days, this stock has, HUG, we'll just say ticker symbol HUG. You're thinking, well, this stock has massive, huge price swings all the time. So yeah, 124, if it has 6 days to go from 124 up to 132, that's nothing. Well, guess what? The market will have already priced that in, and it already knows that too. But you as a trader, assuming that you look at the same ticker symbols over and over again, which is very common for options, then you already know how volatile or non-volatile something is just by watching it, just by virtue of keeping a close eye on it. So you in your mind, by using your experience, quote unquote, using historical volatility, you don't call it that, but you understand, you know how to project that into the future, and these calculations are all just helping you with that. So again, if you know Apple and if you know the way Apple trades, then you would know, wow, yeah, in 6 days for it to make that move, that would take quite a bit. But the market also knows that, and the market, it knows what to expect, what would be impressive, and what would be shocking. So a lot of this is stuff you already know. We're just looking at it in more of a numerical value. And then, of course, like I said, the market's very efficient. All this is priced accordingly. Those options you see out there that you can pick up for a penny, a nickel, I guess in this case you could pick it up for just under 10 cents. Why is that selling for just under 10 cents? Well, the odds of any sort of, true success Not very good. This has 3% chance of being in the money, priced accordingly. And then, of course, I didn't put the price here, but these ones are much more expensive because you have intrinsic value built into it. So not only that, you would just have that much more going for it. So these are going to be much more expensive, but the ones that are, way out of the money, that, their odds of success, the odds of, getting into the money, which now we're understanding, right? Because it probably makes sense. If you've never heard of this, you're thinking, well, yeah, that would make sense. Why, at, less than 5%, odds of getting into the money, why that's only trading for 6 cents by 8 cents. So the market is efficient. It's not like it's going to allow you to take advantage of anything like that. But just one of those things where if you've never quite, really stopped to think, why is that trading for, a penny? Why is that trading for 5 cents? Because the market is looking at the volatility, the time, and it's all, all those pieces are getting put together in one beautiful puzzle. And, this is, the puzzle over here, or I should say at least a big piece of it. Like usual, I got a little bit ahead of myself, but time and volatility risk, aka extrinsic value, influences probability in the money, which is that statistic which we just learned about. And probability in the money is going to influence the price. So let me put on my Captain Obvious hat here. So the more likely something, the higher the cost of the option premium, and vice versa. Again, I'll say that, but the more likely something is to happen, you're going to have to pay more for that, right? Because it's highly likely to happen. Pretty straightforward there, but that's how that all works. Time and volatility risk, extrinsic value, is influencing probability of it being in the money. And if something is more probable to happen, if something is more likely to happen, it's going to influence the price. And in this situation, it's going to increase those option premiums. Now it's increasing it via, implied volatility and via the time risk. But, very straightforward. Perhaps you're thinking, well, if I know earnings or a big announcement is coming, I can buy those low probability of in the monies because that will serve as a catalyst to give a boost that it's going to need, that extra little boost to get the big move. And if you're thinking that, hey, that is actually very clever. It's very logical and rational. I mean, yeah, wow, those things, they're way out there. They have low chances of success, but there's something big coming that can automatically raise up that success because that'll be a big old catalyst. And I can get in, and then when that catalyst happens, the probabilities will increase a lot more because that a big event happened. Well, like I said, the market is very smart. The market is very efficient, and it is well aware of this logic. Again, I want to just reiterate that. You may have been thinking, well, if I know earnings are coming, and if the market believes, and if I believe those earnings are going to be good, then I can hop in at those low probability ones right now. Actually, let's just take a look back. So you're looking at these and you're saying, yeah, I know the price is down here. I know that, but there's earnings coming. Apple is going to have earnings, or maybe Apple's releasing a new product, or, Apple, something is happening. There's something happening. So I understand right now that the probabilities it could be in the money is at 4%, but there's that event coming. And when that event comes and it's going to be big like I think it is, then these probabilities are going to increase much more in my favor because that's a huge catalyst to help catapult the price. I mean, that big catalyst, making this, $8 move, $9 move, that's going to, no problem. That catalyst can help with that price movement and push the price up there. So if that's your logic, like I said, very logical, very clever, and, it makes sense. Try to figure out something before the catalyst because it's coming, and that catalyst will kind of provide the gunpowder that all of a sudden give a boost to the price, and you're sitting pretty, right? Well, let's see. Unfortunately, you are not, because as I've said a million times, and I'm going to continue to say, just because those that try to get a little clever are the ones that suffer from the blowfish effect. So I want to dig into some biology here so I can more illustrate this better. So option premiums, again, due to IV, act just as a blowfish does in the wild. Meaning, when a blowfish is just cruising along and not expecting or anticipating any harm, so nothing wants to eat it, what does it do? Well, nothing. It's normal, right? That's normal. The blowfish is just cruising along, not expecting anything, not anticipating any harm. Nobody wants to eat it, so it's just going to remain normal. Pretty straightforward. However, when a blowfish is cruising along and then is expecting or anticipating harm, aka a predator wants to eat it, what does it do? Well, it's time to implement that self-protection mechanism. And the blowfish does that. It expands because why? Well, it's inspecting something. And the same is true for the options premium and why that logic we just talked about doesn't work. When there's an expected, anticipated, known about, whatever you want to talk about, predator coming, in our case, the predator would be earnings, court rulings, an FDA approval, a product announcement, etc. And I'm not saying predator in a bearish sense in terms of bad. I'm just saying predator in the sense of being known about, being anticipated. That's how I mean predator. So again, predator, I'm not as it has anything to do with bearishness or negativeness towards the stock or whatever. I'm just saying predator in terms of being known about, anticipated. Like I said, earnings people know about. They're on a calendar. Earnings are coming at that day. So again, when there's an expected predator, people expect volatility to rise, right? So if people are expecting volatility to rise because of this known predator, this known, let's just go with earnings, then what makes up the market? People, right? So if people are expecting volatility, then what's that going to do to the market? The market's going to expect volatility. Again, and I keep saying this because I know it's an advanced course. I'm not trying to, insult anybody's intelligence, but I just want to make sure that we're all on the same page. So if people are expecting volatility because on that calendar it says earnings date, boom. Okay, well, earnings date, boom. Stocks get volatile around earnings, right? Things can get crazy. Is it going to be good? Is it going to be bad? Are they going to hit their, estimated revenues? Are they going to, what's going on with their subscription? I mean, all sorts of things. People are expecting things to get crazy. And people make up the market. Therefore, the market is going to expect volatility. So when the market sees, or I should say when the people who make up the market see on that calendar that there's earnings, what does that imply for that date? Looking into the future, and a very good way to look into the future. It's on a calendar, a futuristic date. What's that implying about that period in time? It's going to get volatile. Wait, what are we learning about right now? Implied volatility. So if people are expecting volatility to increase because that earnings is implying it's going to be volatile. Now, volatile in what direction? Who cares? The market we're not expecting it to be good or bad. We're just expecting it to get volatile because it's earnings or because there's a big FDA approval or maybe there's a court ruling on that date. People are expecting things to get pretty volatile. Well, what's that going to do to IV when people are expecting volatility? It's going to expand it, right? The price is going to expand. And remember, IV plays a role in that extrinsic value. So going back to that equation we've already talked about, options premium, intrinsic value plus extrinsic, which is time, and in our case, volatility risk, or boiled down that much more, our implied volatility, that's gonna start to influence this equation, right? So if this part expands, what's that going to do to extrinsic value? It's going to expand it upwards. So when the implied volatility expands, that's going to increase the premium, right? This increases and nothing else. This could stay at 0. This could stay at 0. But if all of a sudden, let's say this was at 0 and this increases to 1, to just keep the math simple, what does that do? Well, this also is going to change to 1. Nothing rocket science there. So there's some key things here, and the thing that so many people miss. So many people. I know you're saying, quit insulting my intelligence. I understand all this. Well, a lot of people don't, and maybe you've even been bitten by it. But notice, nothing has happened with the intrinsic value. And what is intrinsic value? What's that relationship? Oh yeah, the strike price, the price relative to that. So in other words, the underlying stock has not moved at all, yet all of a sudden the option premium went up in price. Again, I want to say that again, very crucial thing here. The underlying stock has not moved, yet the option premium rose. Wait, how's that possible? The stock didn't even do anything. How's that possible? Again, the blowfish effect. The market is expecting, it knows about, it sees on that calendar, hey, there's earnings that day. Hey, there's a court ruling on that day. So because it's expecting volatility, and volatility plays a role in intrinsic value, and intrinsic value plays a role in options premium is headed up, even though intrinsic value is still at 0. So very, very crucial concept here. So let's go back into the animal kingdom. So when the event or in our case, the blowfish, the predator has passed by, the market's expectations for volatility, like the blowfish, what? Well, deflates back to normal. Mr. Blowfish isn't in harm anymore. Why does he need to stay expanded? The predator, the event, the earnings, the court ruling, whatever you want to call it, has passed by. So we're just going to deflate back to normal. And again, IV plays a role in that intrinsic value. So if IV deflates, then what's happening? Well, the option premium is going to decrease in price. So let's just go through that basic math. Let's just say this whole time option premium was at 0. Options premium or intrinsic value was at 0. And then this goes to, let's just say -2. Well, what's that going to do to our option premium? Well, now option premium changes to -2. But this is where things get really interesting and can be very dangerous and painful. Now, that's a matter of perspective. But again, notice, even if the stock moves in your direction and therefore helps the value, because how's that going to help if the underlying stock moves in your direction? What's going to help with that relationship with the strike price? Therefore, intrinsic value is going to help, or is going to start to move in your favor. However, this deflation in an extrinsic value is very painful. So to just kind of add some math, let's say you're right. Let's say the earnings are good. It goes in your favor. So your intrinsic value, and I'm just throwing this out there, rises by 1.5 in this math. Well, what's the problem here still? Intrinsic value rose by 1.5 because, hey, the stock moved in your direction. Well done. However, because things went back to normal, because that event has passed, and it, the volatility deflated back to normal, the blowfish deflated back to normal, intrinsic value lost too. So what does that do for the option premium over here? Now the math is what? Well, you would still be in the hole by 0.5, right? Went down by -2, but you only got 1.5 out of intrinsic. So -0.5, you're still in the hole, even though the price went in your direction. That's why, yeah, it sounds good. I know that event's coming. So I know that event's coming. Their volatility is going to increase, and I can, it can overcome in those 6 days. Apple can overcome that gap between the price and the strike price. Well, the market's thinking that too, and why is the market thinking that? Well, because you are, and you make up the market. And then just quickly, because this will come into play in other strategies, this is a negative from a premium buyer's perspective. Now, if we're selling premium, and I don't want to get ahead of ourselves, well, that's a whole different story. But if you're buying premium, this is where it can hurt, and hurt very badly. Yeah, Clay, you keep talking all this theoretical stuff. You're drawing little equations. Yeah, okay, all right. Well, let's take a look at it like this. Let's take a look at the blowfish effect from real charts. So let's go through 3 of them. Right here, this blue line represents intrinsic value. So there is our implied volatility. So this is our implied volatility. Remember, when implied volatility rises, what does that do to our equation? Well, that raises extrinsic value. So what's that going to do to our option premium? It's going to raise that up too. So when this blue line is increasing, just know that the options premium is increasing too. So this little thing right here, that represents earnings on the chart. Again, this comes from Thinkorswim platform. So this is just where I'm taking this. But again, I don't even use their charts, but this is a fantastic way to show the blowfish effect. But earnings are right here. Now within the animal kingdom, what are the earnings? That's that shark. That's the predator. So the blowfish sees, it's anticipating, it realizes something is coming. What is it going to do? Time to inflate itself. Time to expand. And then right here, notice what happens to the blue line right after earnings, right after the predator has passed. So when the blowfish deflates, goes back to normal, look what happens to implied volatility. This crashes. And when it crashes like that, again, think back to that equation. What's going on with intrinsic value? See you later, bye-bye, down it goes. So even if the stock price goes in your favor, intrinsic value could be going in your favor, but extrinsic value, due to the implied volatility just deflating and going away, that's gonna, basically screw you over when it comes to the options premium. Again, right here, check this out, crazy stuff. Earnings is right here. Okay, well, that earnings is on a calendar, so everybody's going to expect it. Everybody knows when the predator's coming. Mr. Blowfish in the animal kingdom, he's looking, oh, okay, there's a shark coming. I better start to what? Expand. I want to be careful. I want to expand. And then as soon as the shark passes by, okay, I didn't eat me. Things are back to normal. The earnings, after the earnings are done, look at that. Again, just totally crashed downwards. So what is that doing to the options premium? Forget about, the direction of the stock. What is that doing to the options premium? It is decreasing it in price because implied volatility is going down. Therefore, extrinsic value is going down. Therefore, there is a negative there within that equation. Extrinsic value deflating, when the blowfish deflates, goes back to normal, there is a negative in that equation. And then let's just look at one more. Again, on the calendar, these earnings are expected. Okay, blowfish, he's seeing the shark. All right, I need to do my thing. Look at this one. This one, inflated, inflated, inflated. I mean, look at this beautiful trend. And then all of a sudden, what a coincidence that right after earnings, look what happened. Right after the shark passed, the predator's gone, no longer expect anything. Look at what implied volatility did. I mean, fell off a cliff. Down it went. Again, what is that doing to the equation? It's putting a big old negative number in there. So for you folks that just love the math and don't, mind a little mather, when you're getting a big, that's fine. When you're getting all of a sudden a big negative thing here, so this number becomes negative, what does that automatically do to Mr. Intrinsic Value over here? Yeah, Mr. Intrinsic Value can be rising, but it's got to work that much harder, right? Why does it have to work harder? Well, now it's got to overcome this negative number. So you're thinking, I still don't quite, if you don't understand that, let's take a look at a visual. So let's go through, what all this is representing here. You were right, let's say. Your underlying asset right here, it's going in your favor. However, the deflation of IV. So what did we just talk about in that mathematical equation? The negative number in that part of the equation is this big boulder right here. Now, is it impossible for somebody that's a buyer of a premium to still make money? Yeah, it's still possible. However, this is how it works. Look how hard the intrinsic value has to now work because of that little annoying negative portion of the equation. And this is what it is. It's basically the deflation, that negative number. Boy, oh boy. Again, I'm not saying this guy can't push up this big boulder, but he's going to have to work hard. There's going to have to be a lot of things that go in his favor in order to overcome the deflating of the premium, which is therefore decreasing extrinsic value, which is therefore putting in this negative number and just making the buyer of premiums' lives very, very miserable. Okay, I get it, still kind of theoretical stuff, but this comes from multiple members from my chat room, my private trading group, that experienced the blowfish effect. So let's assign some real numbers from something that I have personal experience with, that people, and credit to them for just being honest about it. It's kind of one of those things where they came in the chat room, what's going on? How is this possible? So let's take a look at this, and this is Apple, a real life example. And again, like I said, there is a total credit to them for fessing up and just kind of wondering. I think some of them thought maybe something was broken, or there's a scam going on. But Apple right here, again down here, you can see earnings as expected. So going into earnings, look at that big nasty move. The price closed, so we can assign some numbers to things. So the price closed on that day at 109. So let's 109.14, but let's just call it 109. Earnings were announced the next day, and some of these people, they bought calls, right? Calls, people think the price is going up, so they bought calls when it was down here around 109. The next day, earnings were good. The price opened up. Remember, it closed at 109. So I think visual cues are always a little bit better. So let's just do this. So the close was at 109. People bought calls. Calls, if you don't know that calls mean you think the price is going up, then this course is go back and take options trading simplified. So people bought calls. The opening price the next day, because of earnings, because of that big old volatility, was right here. It opened at 117. Now, I'm not the best with math, but I believe that is an $8 move in their favor, right? The underlying asset went in their favor by $8. Good, you would think, right? Well, maybe you already kind of looked ahead and kind of cheated, but look what happened down here to implied volatility during that period. Notice how implied volatility, notice how that blowfish just totally deflated down here. The shark swam by, the blowfish said, hey, everything's back to normal. I'm going to go back to normal. And it just totally collapsed there. And those people were saying, how is this possible? I am losing money right now. I was right. There is a huge gap up, but I am losing money. I bought calls and I'm losing money on them. Well, that's how. What does that deflation do to that equation? Extrinsic value. I know I've said this a million times. It puts that big old negative number in there. And in this case, even though intrinsic value had an $8 move in its favor, that little guy trying to push the boulder up the hill still could not overcome it, and those people lost money on the premium. Again, I want to say that because this is crazy. Because the market is efficient, because it knew volatility was coming and the blowfish went into effect, those premiums went up so high that when the shark had passed, when the predator had passed, earnings had passed, it just deflated. And that deflation put that big old negative sign into that equation. And the guy trying to push intrinsic value trying to push that up the hill could not overcome the negative. The guy could not overcome the boulder. However you want to look at it, however it best registers in your mind, that's what's going on. And that's how those people in the chat room lost, even though there is this very beautiful gap up. I mean, closed way down here and then opened way up here. $8 move in their favor. However, that decrease put the negative sign in the equation, and extrinsic value totally overwhelmed the intrinsic value move, and the options premiums deflated and people lost money. So it's very real. And at the end of the day, if you're still not buying it, because I'll be the first to admit, this sounds all crazy. How could you have something move in your favor by $8 and not make money on it? I agree. I'm not going to argue with you. That sounds crazy. It sounds like, just spewing a bunch of crap at you right now. I'm not offended if you say, you know what, you don't know what you're talking about. You're full of crap. If I buy a call and the price goes up in my favor by $8, I'm going to make money on that. And if something random happens, I will agree. But if that's happening during earnings, just paper trade earnings. That's all I'm going to say. Paper trade known events. Paper trade court rulings. Paper trade FDA approvals. Paper trade, product announcements. Just so you can see how it reacts. That's all I'll ask if you think I'm full of crap. Like I said, I totally understand. It sounds crazy. But just do some paper trading and you'll see what I mean. Now I'm going to be kind of like a blowfish right now because I'm expecting right now you're thinking, this video is going on 1 hour long. Well, this is why. At the core, the umbrella, however you want to look at it, I'm going to call it the big umbrella of options. This is how everything comes together to form, to kind of figure out, well, what strategy do I want to use depending on what I'm thinking? Meaning, if you are, have a heavy, directional bias, but you think volatility is going to be kind of low, well then, you're going to have a strategy over here. If you are, this thing is going to skyrocket and, your volatility is thinking something else, and you're kind of, volatility, maybe you're going to be over here or over here. Maybe you're thinking, I'm not really sure what direction it's going to go, but things are going to get volatile. Then you're going to be over here, right? You're not sure about the direction, but wow, you expect huge volatility. That's what everything comes down to. You got to understand volatility. You got to understand that because that influences a lot of that extrinsic value. Now, of course, time plays a factor in that too. But you've seen the chart on time. But volatility can easily wipe away that the time risk factor. But then directional bias does come into play too. But as you saw with the blowfish effect, directional bias. Even if you're right in the amount of $8 in your favor, due to this little thing over here, if your expectations weren't right, and if you played that the wrong way, aka you were a buyer of premium instead of a seller of premium, if you don't know what that is, that's perfectly fine. That's why you got the course. We're going to talk about that stuff. Well, then you're going to use a different strategy. So again, a buyer of premium even if they were strongly biased in their direction, and even if they were right, because they were wrong in terms of volatility, because the blowfish effect got them, they may have they did choose the wrong strategy if they bought premium. The right strategy, the correct way in that situation would be to sell the premium because it deflated and you would have made money. Again, we'll cover that stuff. But I spent so much time on this just because it really is, the key kind of foundational blocks of these advanced strategies, because you have to understand what's going on with volatility, what's expected of volatility. And when you think and you can form ideas of what believe is going to be going on, well, then you can start to figure out what sort of strategies you want to use. But of course, you got to know, well, I'm thinking the price is going to go up, I'm thinking it's going to go down, or maybe you think it's just going to chop back and forth, in a sideways movement. Well, that's also, so you're going to have directional biases. Now, how strong you think a directional bias is going to be, that's going to influence things too. But this, little chart, this whatever you want to call it, really summarizes where, the bread and butter, what's at that bottom line of all these strategies, really kind of revolve around, because you have to understand that. So, hopefully you understand implied volatility crystal clear. And, that blowfish effect, that was just kind of an example. But, it's one where, you can still make money from those situations. But in this example, I just want to show you just the power, why volatility plays such a big role, within options, and, how and why you need to respect it so much. So we're done with this one. I know it was long, but a very important concept. So let's keep on moving.